How much do asset managers compete to manage your money? What kind of value do you think they should offer in exchange for the privilege? And should regulators play a role in getting asset managers to show that their services to investors are worth the cost? It's been called the age of asset management. The amount of money in investment funds has soared since the financial crisis, and now people are starting to take a closer look at just how well managed it really is. I'm Scott Martin from Deloitte Centre for Regulatory Strategy, and you're listening to Regulated Radio. I've got Andrew Bully and Joy Kershaw joining me on the show today to give us their views on the latest competitive trends in the investment fund sector and the value for money that those funds offer to investors. We'll be looking at how UK regulators have been leading the pack on pushing asset managers to be more transparent about the value that they offer, what effect we think this could have on the industry, and how we're seeing the best performing funds deal with this trend so far. All this coming up in the next 20 minutes or less. It may be the season of far-flung holidays and lazy afternoons on the beach, but money, as they say, never sleeps, and you'd certainly not want yours to. This is where we'll talk about just how hard your money can work. This is Regulated Radio. The numbers in asset management are sometimes staggering to look at. In 2017, the total amount of assets under management in the EU reached over 25 trillion euros. That's a figure that shot up by over 50% in the last decade since the financial crisis, and in total, that's equivalent to about 147% of the EU's gross domestic product. More than ever before, the wealth and long-term financial security of ordinary people is dependent on financial markets and the investment funds that they entrust their money to. So, in that context, it is understandable that regulators have been taking a much closer look at investment managers. But rather than simply ensuring that they have sound business and risk practices, regulators appear to be increasingly concerned with the value that those funds deliver to their customers and what this says about the health of competition in the asset management sector. So for this, I'm delighted to have Andrew Bully back on the show to share his views. Andrew is a partner in Deloitte Centre for Regulatory Strategy, and you last heard him back in January talking about the regulatory outlook for 2019. Andrew, welcome back.
Thank you, Scott. Delighted to be here.
So, Andrew, we're talking about the competitiveness of the investment fund industry today. This is something that I think most people can relate to quite personally through their own investments. And of course, it's an industry that you've been very close to in your own work. Why is this topic, not the stability or the soundness, but the competitiveness of the investment fund sector, why has this topic attracted so much attention from regulators?
Well, I think this needs to be viewed in a wider context. And that context is really the unusual competition powers that the Financial Conduct Authority has as part of its overall remit. It's unusual amongst conduct regulators in having those powers. And it has an explicit mandate to promote effective competition in the interests of consumers. That has led, I think, to an increasing focus within the FCA's conduct supervision on the economic outcomes that consumers are experiencing. It's going well beyond the processes of distribution and sales of products and services. Now, in the case of the asset management sector, the FCA carried out a market study. It took about 2 years to complete. And overall, this found that asset managers were earning amongst the highest average profit margins across the UK economy, of approximately about 36% over a 6-year period. But the FCA did not find any clear relationship between fund charges and fund performance. And that led them to conclude that competition in the asset management sector wasn't working as effectively as it should be.
But Andrew, just one personal doubt of mine. There's obviously a multitude of funds in the market to choose from, and they offer investors a whole range of choices on what risk level they want to take, the industry they want to invest in, even their geographic focus. Why would competition be an issue in such a busy marketplace?
So, Scott, yes, I'd agree. There are a lot of funds in the market to choose from. In fact, almost a bewildering choice in some cases. And it can be hard for investors to know which of these funds offer good value for money. Not all investors pay close attention to information about costs and charges. Those that do can find it quite hard sometimes to understand and compare the information between funds and also between different types of investment product. Now, there has been work going on at the EU level to improve the clarity and comparability of investor disclosures, but that's not always been a straightforward matter, and we're still some way from the goal of having a clear and consistent regime across both funds and across different investment product types.
Now, I'm wondering, how would you say that the rising popularity of index trackers or passively managed funds has affected the state of competition in the industry?
Yeah, it's a good question. I mean, passive investing is not a new concept. It's been going for a long time. It's been very popular in the US in particular. But in the past few years, there has been a significant increase in passive investing. And just to clarify exactly what we mean by that phrase, this is where the fund tracks an index rather than trying to beat the market as such. It's been accelerated a bit by the introduction of a new product called the exchange-traded funds, which are essentially passive products. But I think the key driver is that passive funds are generally cheaper than active funds. And this has led to more competition on pricing and more focus on how active funds are adding value. And on that latter point, there's quite a significant amount of research, really frankly led by the regulators in this area, which has concluded that on average, and I'm quoting the FCA directly on this now, on average, active funds underperform their benchmarks after charges. That said, I mean, active management does have a role to play even within a largely passive portfolio. So in certain markets, smaller companies, etc., less liquid markets, clearly active management offers a much wider range of choice than the index products would do so. And also the Financial Conduct Authority has looked into this, and it's found that the increase in passive investing may potentially decrease market efficiency if it contributes less to price discovery and may result in less active stewardship. And I think from a prudential perspective, potentially passive investing does have the potential to exaggerate market savings. So there are pros and cons around passive investing, but nevertheless, there is a clear trend towards it in the market, and that has increased competitive pressure for the asset managers.
So I want to bring in my colleague Joy Kershaw to dig into this topic a bit more. Joy is a senior manager in the Center for Regulatory Strategy, specializing in investment management. Joy, welcome to the show. It's great to have you.
It's great to be here, Scott.
I'd be interested if you could give our listeners your view on why the competitiveness of the investment fund sector and the value they deliver to their investors is suddenly so important today.
Well, in the past 10 years, we've seen a huge increase in the number of people with defined contribution pension schemes, which has been accelerated by the rise of automatic enrolment. We've also seen a decline in the number of people with defined benefit pensions. So with defined benefit pensions, employers commit to providing a pre-agreed level of income in retirement. So if the pension is invested in poor value products, the employer will have to make up for any shortfalls. Whereas with defined contribution pensions, the amount of money a person has in retirement depends directly on the performance of their pension investments after charges, which will in turn depend on whether the funds they've invested in provide value for money. So with the impact of poor value products shifting from the employer to the individual, individuals will need to pay more attention to the value they're getting.
So let's get into some of the specifics here. We've said in the show that UK regulators are taking a closer look at this, becoming more involved. Joy, what exactly is the FCA asking fund managers to do in order to demonstrate value for their clients' money?
Well, the Financial Conduct Authority has introduced new rules requiring authorised fund managers in the UK to assess the overall value that their funds deliver to investors. And a summary of these assessments must be published annually, with the first publications due in January 2020. Where a fund is not providing value for money, authorised fund managers must explain what action they're taking to address this. And in addition, the Financial Conduct Authority is requiring authorised fund managers to have at least 2 independent directors on their board, and for independent directors to make up at least 25% of board membership. And this is designed to boost the amount of independent scrutiny in firms' governance, including when the authorised fund manager's board signs off the value assessments.
So, Joy, call me a skeptic, but do you think this will be taken seriously? And I ask that because if it's in the hands of asset managers themselves to perform the assessment of the value that they're offering, surely the industry will give itself a relatively good score.
Well, the assessments will need to be signed off by the board of the authorised fund manager, and the FCA's new requirements to introduce independent directors are designed precisely to try to make those boards more independent. In addition, the Financial Conduct Authority is introducing individual accountability for a firm's assessment of value under the Senior Managers and Certification regime, which is the first time it has done this in any sector. This means that if the accountable individual has not taken reasonable steps to ensure that the firm complies with its obligations in this area, they could face sanctions on them as an individual. There's also the fact that a summary of the reports will have to be published, so the assessment will need to be credible enough to convince the market.
But how do you establish that kind of credibility?
Well, if, for example, a fund has higher charges than comparable funds but has poorer performance, it may be difficult to justify this credibly, so the firm will need to explain how the fund really provides value or what action it's taking to address it if it isn't. At the end of the day, the FCA will be expecting to see firms taking tangible actions to improve value for money as a result of these assessments. So if not very many firms are doing this, then it's likely to put more pressure on firms through its supervisory work, and it may even introduce more stringent rules, such as requiring a majority of independent directors on the board.
So Andrew, I want to get a better sense of just how much of an impact this might have on what I think we all agree is a really big sector. Even if firms produced robust and fair assessments of the value they're delivering for their customers, are those customers even going to read this stuff or be able to understand it? Surely it's just going to be a small minority or maybe even people like us.
Well, I would agree that there's likely to be variable levels of investor interest in these assessments, though I wouldn't underestimate the level of interest that the more informed investors will be taking in them. But let's not forget, these are important exercises from both a regulatory and a reputational point of view. And there's going to be a lot of wider market interest in the outcome. We think the value assessments are likely to be picked up by distributors, in particular advisors, by platform analysts, etc., as part of their decisions on which fund selections they will be offering. And we also think that institutional investors will be paying very close attention to these value assessments. Don't forget, institutional investors are also investing in these authorised funds. And I think in that regard, it's quite significant that some firms are even considering doing the assessments for funds which fall out of scope, i.e. they're managed outside of the UK, because they think that's what the market will expect of them.
All right, so as you say, this could indeed have quite a big impact on this sector. But Andrew, when you're talking to investment managers who are on the receiving end of this in the work that you do, what are you advising them to do, not just to comply with it, but also make the most of it?
Yeah, we would certainly agree on the impact as you characterise it, Scott. And we've produced a report which sets out how we would recommend firms approach these value assessments and also take stock on the sort of practices we're observing in the market at the moment. I think the key point to emphasise is that there are reputational as well as regulatory issues flowing from these reports. And at the end of the day, firms need to be able to just demonstrate value. Now, value is a more complicated concept than just cheapest. This is not just about being the cheapest fund. So, for example, if an active fund is underperforming, a key question is going to be immediately, well, how is the firm going to make its performance improve? We're also emphasising the importance of adopting a consistent methodology across the assessments. Now, the FCA is given reasonable latitude as to the various criteria that can be used in these assessments, but it's obviously important that funds are not seen to be cherry-picking in terms of the criteria they're majoring on. Another significant issue, I think, is that between retail investor charges and how they compare with wholesale investor charges. Where there is a difference, we think the assessments will need to explain why that is and whether they are justifiable. There's also the ongoing issue of what's called closet tracking. That's an area the FCA has been particularly interested in, and we expect that these value assessments will need to assess this very closely indeed. We think it's important that the published reports are user-friendly and easy to understand. They are ultimately aimed at consumers. But perhaps the most important point is the need to engage with the spirit of these exercises, which is essentially to ensure that the board themselves are asking the question as to whether they are delivering value for money. That has very, very much been the FCA's remit in terms of ensuring through the senior managers regime that boards are fully addressing that value question. So we're recommending very strongly that boards are engaged at all levels throughout the process.
So Joy, I want to get your view on something. This is mostly, I think it's fair to say, a UK trend that we've been discussing so far. But do you see much scope for European regulators to start doing something similar to this? And what I mean is that at the EU level, we're going to have a new European Commission later this year. And do you think this could be on their financial services agenda?
Well, we've already seen interest on this topic at EU level. So far, measures in the EU have focused on improving investor disclosures, especially on costs and charges. This has included making the cost of investment research more transparent, as well as probing funds that charge fees for active management, but invest a high proportion of their assets in an index, so-called closet trackers, which Andrew mentioned earlier. Recent research by the European Securities and Markets Authority has found that retail investors pay twice as much on average as institutional investors, and we're increasingly seeing the EU bodies talking the language of value for money. That said, most regulators in the EU don't have an explicit competition mandate like the Financial Conduct Authority. But nevertheless, we should expect to see more focus on this area, and it's likely that there will be something on value for money in the European Commission's financial services agenda.
All right, so before we wrap up the show, we always ask every guest on Regulated Radio to make a prediction before they leave. And since there's two of you here today, I'm looking forward to two bold, gutsy predictions about where you see the asset management sector and its regulation going in the next few years. Andrew, you first.
Okay, well, I think from my perspective, there is one issue that's overshadowing the regulation of the fund management sector at the moment, and that is clearly that of fund liquidity. We've had a series of gating of specialist property funds, and that's now spread as a problem to the recent suspension of a fairly high-profile UK equity retail fund. Now, this whole issue of fund liquidity has been on the regulatory agenda for some time, both in the UK and internationally, and I think that recent market events are only going to increase that trend.
And Joy, what about you?
Well, I think we're likely to see more focus on how asset managers are dealing with broader societal issues, such as diversity and sustainability. We can expect to see more scrutiny both of how asset managers deal with this in their own organisations, for example, whether they're making an effort to recruit the best staff regardless of background, and how they're reducing their own carbon footprint, but also of how asset managers are influencing the companies they invest in as part of their role as shareholders.
All right, Andrew, Joy, thanks so much for coming on Regulated Radio today.
Thank you.
Thank you.
And there you have it, a really critical regulatory trend for an immense and fast-growing part of the financial sector. If you're interested in learning more about regulatory action around fund value assessments, you can read our full report on this at deloitte.co.uk/value for money. Now remember, if you like the show, hit the subscribe button to ensure you receive notifications about new episodes. And if you're already subscribed, you can give us a review on your platform of choice or email us with your thoughts at regulatedradio@deloitte.co.uk. We would love to hear from you. And don't forget, if you listen to Regulated Radio and think, this is brilliant, then do us a big favor and recommend the show to a friend or a colleague. Everyone likes a good podcast to brighten their day. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.